Hi friends, we are starting a face-to-face offline batch in Bangalore with SS Academy. That is for CA Final Financial Reporting paper number 1. Yeah, we'll be taking exactly 2 months from 1st November to 31st December. We'll complete it. It is starting from 1st November 2022. Yes, and in Jayanagara branch of SS Academy, we have morning batch and evening batch will be at Seshadripuram SS Academy. Right, and if the student is missing because of any reasons, right, they are going to get a backup class. All right, we'll ensure that their things, I mean, they will study and complete. And from the face-to-face batch, you know the benefits out of it. We'll be completing the syllabus in time. You don't need to postpone and you don't need to compromise for your goals. See you in the class. Please share this information with your friends. That will help me and as well. Thank you. Hi friends. This is part 2 of SBP, which you are aware. The topic number 1, equity settled SBP, is completed. Now let us look at cash settled SBP. Yeah, see, in case of cash settled SBP, as we already discussed, employee benefit expense account debit to SBPL, share based payment liability you are going to recognize because I am liable to pay them either cash or any other assets. Right. The asset value or cash value will be measured with respect to the shares value. Perfect. Right. So, but here what is the difference? In case of equity settled share based payment, the fair market value of the option on the grant date will not be revised. But with respect to cash settled share based payments, you are supposed to remeasure the value of the option on every balance sheet date and on the till the date of settlement, every balance sheet date, and even on the date of settlement also you are supposed to remeasure it. Yeah, and remeasure and prospective accounting is going to be there. And this cash settled share based payment, I mean, people do call examination when they will ask you as SAR, share appreciation rights. Okay, share appreciation rights is the word people will use it. Suppose if it is vested immediately, yeah, if it is vested immediately, what will happen? Entirely cash settle, I mean, employee benefit expense account debit to SBPL, and SBPL account debit to cash or other assets, whatever you give it to employees. That's it. This topic is easy, and from here only number of times questions are being asked. And the next topic number 3, if you see, share based payment transaction with cash alternative. That means the employee or other party will be having an option. I mean, on the last day, employer or employee, it can be anybody. Okay, anybody can be having an option of what? Right, whether they wanted cash, then company has to give the cash. If the employee wanted in equity, then company will give you the equity. Okay, the option is there. Right, under that circumstance, what do you do? Generally, the option will be with respect to the employee. Right, the employer, yes, it is possible to keep it. That is what given even by the SBP standard also has given that option, but practically you will find it very, very rare. Okay, fine, not a problem. With respect to entity, I mean, from examination point of view, not that relevant and important, and there is no question from the institute material as well. Let's focus on the counterparty, that is employee has the option or supplier of the goods has the option. Okay, right. Situation number 1. Yeah, the counterparties other than employees are. Yeah, then it very simple, my dear. This share based payment arrangement is going to be treated as a compound financial instrument. Okay, you know, under Ind AS 109, if it is a compound in the sense there is an equity element, there is a liability element, then you are supposed to bifurcate it and account it. Yeah, same thing you are going to do it here. What is the fair value of equity? Fair value of the equity is equal to fair market value of the goods or services minus fair market value of the debt. Yeah, how much they are expected to pay, that you bring it to present value, and that will be deducted from the goods or services. The remaining amount is equal to equity. Equity element will be accounted as a equity settled share based payment, and the liability debt portion will be accounted as cash settled share based payment. Okay, and that is a simple one. Right, second situation is situation number 2, where the counterparty is an employee. Yeah, counterparty is employee here also. No, suppose if you give a choice to the employee, do you want cash or do you want equity? Generally, with respect to equity, my dear, there will be restriction period, lock-in period kind. What is lock-in period? I mean, I will give you the share, but you cannot sell it in the market for next 2 years or 3 years. That's why the interest and importance to, opting for the equity, will be lesser compared to the cash option. Because if it is the cash option, even if it is less money, I will be, as an employee, I will say I'll take cash, not the equity share. Because if I take the equity share, maybe after 3 years, if the value of the share falls down, that's going to be a loss to me. Correct. I'll say I'll take cash and I'll purchase whichever the share, whatever the company share I want. What do you say? Yeah, exactly. So that's the reason, my dear. So in this case, what are you supposed to do? In this case, first you find out the fair market value of the equity option, how much, and fair market value of the cash option, how much. Fair market value of the cash option, yes, that will be the cash liability portion, we will call it. Equity option value, mostly it will be given more. The example, fair market value of the liability option is equal to 100. Fair market value of the equity option is equal to 120. 20 will be treated as a equity settled SBP. The 100 will be treated as a cash settled SBP. This 100 cash settled SBP, right? Cash settled SBP has to be remeasured every balance sheet date till the date of settlement. Yes, you are supposed to do like that. And equity settled SBP, you will grant date, fair market value of the option will take it and will never remeasure it. That will be accrued over the period of the vesting period as usual. Okay. And if the employee, suppose, sir, today we thought it will be happening equity, and tomorrow it may happen cash settlement can happen. Yeah, or vice versa can happen. Yes. So suppose if it is, what is that? We thought cash, end of the day, what is happening? End of the day, sir, cash settle, equity settle happened, sir. Okay, fine. What is there? SBPR account you have already, SBPR account, debit. Correct. Now, liability account also you have created, that also is debit. And two equity share capital, two security premium will clear it off. Or if you are supposed to pay cash to them, okay, fine. Then liability account debit to cash, and SBPR account is there. Correct. Now, SBPR account will be transferred to retained earnings. We will be transferring. That's it. Right. Let's go to the last topic, that is topic number 4, share-based payment transactions among the group entities. That is the parent and subsidiary company between it is happening. Correct. So in this case, generally what will happen, subsidiary company will be receiving the goods or services, but wherein the payment may be happening from the holding company point of view. Yes, the company which is receiving the goods, correct na? If it is receiving the goods, even though if it does not have an obligation to pay, if it does not have an obligation to settle it, then it is obviously equity settled share-based payment for that entity. Suppose subsidiary receiving the goods, but is not going to pay, is not going to issue any shares of it own shares, it's not going to give. Then it is equity settled for them. But for the holding company, it is not receiving goods, but it is supposed to give the shares, then it is equity settled share based payment. If it is supposed to give cash or some other assets, then it is a cash settled share based payment to the holding company or parent company. Here actually 4 circumstances can come arise, my dear, but generally the first circumstance is what given clearly in the textbook, but rest of the things are all are available very clearly under Ind AS 1 or 2 standard mein de diya, but not in ICA textbook in detail. Yeah. So situation number 1, parent issues the shares or options directly to the employees. Correct. So in this case, subsidiary receiving the goods or services, but subsidiary will not give any shares. Then what will happen, my dear? Employee, you are receiving the goods, right? The goods or service, that is employee benefit expenses account or goods account debit to capital reserve directly, because it is other equity for them. It is a capital contribution by the parent company. Correct. Wherein they are giving me something, but they are not asking anything. That's why I have to transfer it to capital reserve. But what about the parent company? Parent company is going to issue the shares to them. It is not receiving the any services. That's why investment in subsidiary account debit to equity share capital, SBPR, you will write it. First investment subsidiary account debit to SBPR for 1 to 3 years. Right, at the end of the day, what do you do? SBPR account debit to equity share capital to security premium will be recorded. And situation number 2 is what? Subsidiary providing the right to its employee to get the equity interest of its parent. Means subsidiary company only, what will happen? Subsidiary company will purchase the shares in the market and give it to employee. Okay, right. So here how can it happen? It can buy the shares in first option. First option, if you observe here, subsidiary buys from the market. From the market we are buying. Okay, that means we have got an obligation to buy it. Yes, exactly. Correct. So employee benefit expense account debit to SBP liability. Yes, it is a liability. We are not giving our own shares. We are purchasing some shares of the parent company shares. I am buying in the market. I am giving it to this. That's why it is a cash settled option to us. We are giving other asset, not our own equity instruments. Right. Other way around, what subsidiary is getting the shares from, parent company will give the shares to subsidiary company will give those shares to the employees of the company. Right. Now, in this case, have you spent any money? No, I have not spent. Then it is a capital reserve for you. Employee benefit expense account debit to capital reserve. Right. And at the same time, parent company investment account debit, current investment in subsidiary account debit to equity share capital to security prime will be recorded by the parent company. See the third situation, my dear. Parent settles by giving the cash value of SB plan issued by the subsidiary. Yeah, issuer of the plan is the subsidiary company, but settlement will be done by the parent company. Here also almost same kind of thing will come, but remember, parent is giving not equity, parent is giving the cash. That's why for the parent company it is a cash settled SBP. For the subsidiary company it is a equity settled SBP, because it is receiving the shares, it is receiving the goods or services, it does not have an obligation to pay. Okay. Situation number 4. Yeah, transfer of employees among the group. Okay, it's a group company. I may be having 10 subsidiaries. Yeah, suppose sometime what happens, if you work with subsidiary A for 2 years, you be within the group maybe for say example 3 years. You may be 1 year in one, subsidiary A, subsidiary B, subsidiary B. One year if you work also, no problem. You are entitled for this. Under this circumstance, what will happen, my dear? Very simple. Yeah, it's a subsidiary A, with subsidiary A employee working for 1 year. 1 year related journal entry will be recorded by subsidiary A. Subsidiary B also 1 year entry. Subsidiary C also 1 year entry. But wherein holding company will be recording for all the 3 years, because settlement will be happening by the parent company. That's the last small topic about the standard. First adoption of Ind AS. Yeah, from based on this, in November 2022 RTP examination, RTP mein one question was given. Right. See, this is very clear, my dear. If it is if it is already vested as on the date of transition, if it is already vested, you don't need to follow retrospectively, not at all required. Forget about your Ind AS 102. Forget about Ind AS 102. That's it. No, no, sir. We have already SBP, sir. It is not vested as on date of transition. Then you don't have a chance. You don't have a choice. You have to follow retrospectively, calculate on the date of the grant date, what is the fair market value of the option, correct? From the grant date to till the date of transition, correct? Then you do, what is that? SBPR account debit to retained earnings. SBPR account, this you record on the date of transition. Previous year as usual it will go to P&L, current year it will go to P&L, prospectively it will be accounted for from that date. That's it, my dear, and wish you all the very best for your examinations.